What's the best legal tax law every real estate investor should know about? The infamous 1031 exchange. 1031 exchange is how a small real estate investor becomes a wealthy multifamily property owner. This tax law is not just for the wealthy, it's also for small investors like you and I. In today's video, we wanted to share with you guys our firsthand experience of actually doing a 1031 exchange, what we learned, and how we bought a brand new property for just $600. That's right, $600 for an 1,800 square foot, 3-bedroom, 2-bathroom, brand new property. If you're interested, then keep on watching. Hey guys, welcome back to our channel. If you're new here, my name is Elma and this is Jerwin
and Siopao.
Our channel is about sharing our journey to reaching 8/12/2024, which is our retirement date.
We cover topics such as real estate investing, stock market investing, financial education, and once in a while we'll throw in some of our travels as well. But make sure you join us to our path to 8/12/24, which is our FI date. And stay till the end for Siopao's tip of the week.
First, let's go over what a 1031 exchange is. If you go on the IRS website, IRC Internal Revenue Code section 1031 goes over how a real estate investor can defer paying capital gains by purchasing a like-kind property. The like-kind is very general, but essentially if you are planning on selling real estate, you must make sure you also buy real estate. There are some rules to follow and the rules are not flexible whatsoever.
Okay, so let's talk about the rules of doing a 1031 exchange. Now there are many other stipulations that we won't talk about here, so make sure when doing such a complicated transaction, you speak to your CPA. The rules we will highlight are the most common ones. If you want additional details, feel free to read the IRS tax laws.
Rule number 1. It must be an investment property. It cannot be a primary residence or it cannot be a flip property. If you guys don't know, a flip property is a property you purchase that's typically run down and beat up and you add value to it by fixing it up, whether that's replacing flooring, painting it, or even remodeling the kitchen. Once you made it all pretty, you sell it for a profit.
Rule number 2. You have 45 days to identify a replacement property or properties, and you must close the entire transaction within 180 days of selling the property you intended to do a 1031 exchange with. Every rule has an exception, right? Well, not this one. There are no exceptions. Zip, zero, nada, nothing. Once you get to the 181 days, you are fully responsible for paying your taxes on your entire capital gains. So for example, if the property you are selling sold for $200,000 and you netted $100,000, you have to meet the 181 days. Once you get to 181 days, Uncle Sam's gonna want his share, which is probably 15 to 20%.
Rule number 3. You must use the entire amount of your expected proceeds from this sale. For this example, we will use our own property. When we sold our Mountain's Edge home, the net profit was $100,000. For easier math, we'll use the same example from earlier. We had a loan for $100,000 and we sold it for $200,000, meaning $100,000 was our profit. To meet the requirements for the 1031 exchange, the entire $100,000 had to go into a new property. So essentially, you must invest all the gains you have made into the new property. On top of that, you have to make sure the new property is more than or equal to what you are selling the original property for. Confusing, right?
Now let's go over the pros of doing a 1031 exchange and why we did it. Some people think the gains are tax-free since it's being rolled over into the new property. Well, it's actually tax deferred. Now that's very different from being tax-free. Tax deferred means you're just taking the tax hit down the road. Tax-free means Uncle Sam is giving you all the capital gains without wanting his fair share. That'd be nice though, right?
If you do this right, it's an excellent way to build generational wealth very quickly. The 1%, the really rich folks, will probably never pay for taxes on their investment property because they will just continue to keep deferring it forever. Even when they pass it down to their kids and their kids pass it down to their kids, this is why it's called generational wealth.
Another pro is that a single family, 3-bedroom, 2-bath, 1,200 square feet home can one day become a huge commercial building. Crazy, right? It just means you have to keep doing a 1031 exchange, starting with a single family, then into a 4-plex, then maybe into an 8-unit, and then a 16-unit, and on and on and on. During that entire process, if done right, you'll be paying $0 in taxes. You're also gonna probably increase your cash flow as well. Of course, all rules and laws have their cons too. Here are some of the cons with a 1031 exchange. First, the money stays in real estate forever. Unless, of course, you want to pay a tip to Uncle Sam to between 15 and 20%. There's a famous line by some famous person, and it goes something like this. If you put money in real estate, it stays in real estate forever.
Another con we actually referenced earlier are the time frames. Having to meet certain time frames like selling and buying a property that meets the 1031 exchange requirement all within 180 days can get overwhelming. And like we said earlier, there's no grace period whatsoever. Just to make your life easier, always consult with a professional. Even though we have personally gone through the process, we're not professionals. We're literally just two Asians and our dog on YouTube sharing our experiences. The 1031 exchange process is complex and tax laws are complicated. You want a knowledgeable professional by your side to walk you through the process.
So before we go over our numbers, let's quickly go over how long-term capital gains are taxed. A typical tax rate for the sale of an asset held for more than 365 days in 2021 is 15% for a married couple earning $78,000 to $488,000. If you make $488,000, congratulations, you are making a boatload of money. And honestly, you're probably not watching us. But if you are, your capital gains is around 20%. As you see, there's a significant portion you would have to pay if you choose not to transfer your gains into your next property.
Okay, so what you guys have been waiting for are numbers. This property we'll refer to as Mountain's Edge. It's a good name because the property was located near the edge of a mountain. We bought Mountain's Edge in 2007. When we purchased it, there was already a family living in it, which made it so easy for us because we didn't need to find anyone else to rent it out. At that point, the family had been living there for 2 years. The day we sold it was the day that they moved out. So the family stayed in the property the entire length of time we owned it, which was over 5 years.
We decided to sell it because the property did take some beatings. One of the members of the family was wheelchair bound and they had to do some minor upgrades to the property. Also, having a wheelchair in the house completely destroyed the carpet and just about all the walls and doors. The bottom of the kitchen cabinets got pretty roughed up as well, and the AC unit was just about to die on us. We sold the house March 2019 before summer, and an AC tech mentioned that we would probably have to get a brand new unit before summer started, which means that that's an additional $4,000 to $6,000 in expenses. And remember, we would have to replace all the floorings, cabinets, and doors. We estimated approximately $25,000 in rehab to get the home rent ready. When we did the math, it just didn't make sense for us. It would have taken us 36 months to recoup the losses.
That's when we decided doing a 1031 exchange made more financial sense. We had the opportunity to sell the property and use the equity we built up into another property. Prior to listing our current property, we went on a hunt to find potential new properties. Everything has to happen very quickly, so we knew we wanted to identify a few potential properties. We then came across a brand new property, which was definitely a direction we felt comfortable taking. On top of that, we were able to literally double our rental income because of the community, and the rental rate was significantly higher in the new community.
Okay, let's take a look at our actual numbers. Mountain's Edge was purchased on December 18th, 2014 for $155,000. Our down payment was $34,000. We ended up selling it 5 years later on March 8th, 2019 for $229,000 with a total net profit of just a little bit below $100,000, $99,000. This included our down payment as well. We had one family living in there the entire time we owned it.
We did encounter a few minor hiccups along the way, which we will tell you guys so you can learn from our situation. When doing a 1031 exchange, you must make sure that the ownership is the same, meaning if you own the home inside your trust, you must purchase the next home inside the trust. Or if the property is under husband and wife, the next property must be under the same. Let's just say our ownership was not the same. So we had to move things in and out of our trust and LLC before completing the exchange, which resulted in us paying some additional expenses along with additional transfer fees.
Another hiccup we experienced was the next home we were buying was ready and built before our property we were selling actually was sold. Us buying a brand new home build made it more complicated because the new build was ready to close a few weeks before we had the money. Being a real estate agent here in Las Vegas, I have great relationships with builders, so I was able to delay it a little bit. Typically, we would have been in a compromising situation if they didn't know me personally. Like we said earlier, Just be aware of the timeframes for a 1031 exchange.
We hope you will be able to use this tax code to your advantage in the future to grow your real estate empire. This is one of the most used tax benefits for us small investors to the billionaire investors alike. If you guys want additional details or additional advice, please don't hesitate to message us or comment below. And always remember, real estate is a long-term investment. That's everything we have for you guys today. If you found this video helpful and you found value in it, please don't forget to hit that thumbs up button and subscribe to see more videos on personal finance, real estate, and stock market investing. Now it's time for Siopao's tip of the week.
Siopao's tip of the week. We have a bonus one. We have two. Tip number one, make sure to add an accountant or CPA to your real estate investing team.
Okay, and the bonus, work with a qualified 1031 exchange intermediary.